All right, let's talk about something huge. We're breaking down an event that sent absolute shockwaves through global markets, a military escalation right in the Persian Gulf, at the world's most critical energy choke point. So, let's get right into it. What happened, and more importantly, what does it mean for your money?
Okay, so picture this. It's Saturday, February 28th, 2026. Markets are quiet, everyone's enjoying the weekend. But behind the scenes, something big was starting to unfold, something that would completely reprice geopolitical risk across every single asset class by the time those opening bells rang on Monday morning.
And this quote right here, it really nails it. This wasn't just another regional flare-up, the kind we've seen before. No, the scale of this military action created a genuine systemic shock for investors. We're talking about a type of risk that, frankly, hasn't really been on the table for a very, very long time.
So, here's our game plan for today. We'll kick things off with how the war started, then zoom in on the Hormuz choke point. After that, we'll look at the market shockwave and the flight to safety, and wrap up with what investors should be watching next.
All right, first up, how this whole thing kicked off. So what exactly happened? Well, on that Saturday, a joint U.S.-Israeli military operation was launched against Iran. And let me tell you, it was clear from the get-go that this was the biggest intervention in the region since the 2003 invasion of Iraq.
And the escalation was, well, it was severe. We're talking about coordinated strikes with a clear objective, targeting the survival of the Iranian regime itself. Iran's response was fast and direct, retaliatory strikes on U.S. bases in the area. That led to the U.S. president declaring major combat operations. And for Israel, this was the largest airstrike sortie in the country's entire history. Just wow.
And all of this action, it brings us right to the economic epicenter of this whole crisis. All this military might is focused on one tiny but absolutely critical logistical artery on the planet, the Strait of Hormuz.
So, what is the Strait of Hormuz? It's basically the only sea passage out of the Persian Gulf. It's the exit door. The big problem is its geography. At its narrowest point, that shipping lane is just 33 kilometers. That's 21 miles wide. Think about that. It puts every single vessel squarely within easy striking distance of the Iranian coast.
Now, if there's one number you need to remember from all of this, it's this one, 20%. A full fifth of the entire world's daily petroleum and liquefied natural gas consumption has to squeeze through that one tiny choke point every single day. That's just staggering.
And just look at who relies on this strait. It's a who's who of energy giants. We're talking about the world's largest oil exporter, Saudi Arabia, OPEC's second largest producer, Iraq, and the world's #1 exporter of LNG, Qatar. Not to mention Kuwait and Iran itself. They are all almost completely dependent on this one passage.
So the first question any smart investor asks is, okay, what about a workaround? Are there alternatives? Well, this is why there's no easy fix. You've got some bypass pipelines from Saudi Arabia and the UAE, right? But their combined spare capacity is only about 2.6 million barrels per day. The Strait, it handles around 20 million barrels per day. The math just doesn't add up. There is no way you can pipe your way around a full-blown disruption in the Strait of Hormuz.
Okay, so with stakes that high, the market's reaction was exactly what you'd expect, fast and brutal. It was a classic risk-off event. Money just fled from equities and gushed into assets that are seen as safe havens. And of course, oil prices absolutely spiked on fears of a massive supply crunch.
You could feel the anxiety building even before the weekend hit. In those last few hours of trading on Friday, the Dow dropped over 500 points, more than a 1% slide. But the real tell was what happened in after-hours trading once the strikes were confirmed. Dow futures just plummeted, dropping another 622 points.
So what caused that huge surge in oil prices? Well, it was really two things. First, you had a direct physical disruption. Major trading houses just flat out suspended shipments through the Strait. Done. Second, for any ships that were even considering the journey, the insurance costs, what they call war risk premiums, went through the roof, jumping by as much as 50%. That risk gets priced right into the cost of every barrel.
So the big question is, if money was rushing out of stocks, where did it go? This crisis turned into a fascinating real-world stress test for all those so-called safe haven assets. And let me tell you, there were some very clear winners and one very notable loser.
And this breakdown tells the whole story. Gold had its best month since 2012, rocketing up 11% as investors ran to its age-old reputation as a store of value. Silver did even better. The Swiss franc proved yet again why it's the go-to currency when Europe gets nervous. And then you have Bitcoin. Instead of being a safe haven, it dropped. It basically traded like just another risky tech stock.
And this chart just makes that split so incredibly clear. I mean, the whole digital gold theory was put to the ultimate real-world test right in the middle of a hot military conflict, and it failed spectacularly. While gold surged 11%, Bitcoin fell 2%. When the chips were really down, capital chose thousands of years of history over a decade of hype.
Okay, so that's what happened. The really crucial question now is, where do we go from here? So let's pivot to a forward-looking view. What are the key scenarios, and more importantly, what are the strategic takeaways for you as an investor?
Pretty much everything in the market right now hinges on the price of oil. We're looking at three main scenarios here. First, a short-term, moderate disruption. That probably keeps Brent crude oil in that $70 to $80 range. But if this thing drags on, a persistent conflict pushes us toward $91 a barrel, and that adds some serious inflationary pressure. And a total blockade, we're talking oil well over $100, and that adds more than a full percentage point to global inflation. That's a huge deal.
So what's the move? How should investors be positioning their portfolios? It really boils down to 4 key strategic takeaways. Number 1, think of defense contractors, especially those with recurring software and maintenance revenue, as a new growth pillar. 2, precious metals prove their worth. Use gold and silver to hedge against that tail risk of this getting even worse. 3, diversify geographically. Look at markets less tangled up in Gulf logistics like Japan's Nikkei. And finally, number 4, keep your eyes glued to that $91 oil price. That is the magic number that could force the Fed's hand on inflation even if the economy is slowing down.
And that all brings us to the final and most important question. Markets are fast, right? They've already priced in the fact that there's a conflict. But have they really priced in a full, sustained closure of the Strait of Hormuz? That is the multi-trillion-dollar question that's hanging over the entire global economy right now. What happens next?